finally on to the industrial market snapshot. We have the overview of the stats, the current status, the trends, and the tenant perspective as well.
Okay, thanks, Ed. So, whilst we don't have any new data since the last update on vacancies, we've previously spoken about, just how tight the industrial market is, which is apparent from the numbers you see on the screen. However, there do appear to be early signs that the larger markets like Sydney, Melbourne, and Brisbane are starting to moderate, whilst New Zealand and other Australian markets have plateaued somewhat. So therefore, our forecast is those smaller markets won't see much rental growth, and we will start to see effective rents come down as incentives increase.
Thanks, Gillian. One of the key differences this quarter is that e-commerce penetration, or the amount we buy online, is stabilizing as a result of cost of living pressures. For industrial occupiers, this is a glimmer of hope. As we have previously reported, e-commerce has been the primary consumer of warehouse space, which has led to the current low vacancy rates and upward pressure on rentals. There is still very low levels of supply, and around half of the new stock coming onto the market over the next 12 to 18 months is pre-committed. But the new stock and a reduced demand will certainly relieve some of the pressures and rentals. In other good news, vacancy rates have stabilised, or as in the case of some areas of Australia and the New Zealand markets, vacancy rates have increased. Despite this, Australia still has the unenviable record of having the lowest vacancies in the world. In the absence of major injection of uncommitted stock coming into the market, we anticipate that vacancy levels will remain low for the foreseeable future. Nevertheless, more recent data is clearly showing an adjustment in response to the market conditions, and there is now evidence of incentives gradually on the rise, which may go some way to offset the rental growth. On to trends. The industrial market remains resistant to the economic tailwinds and global uncertainty. However, there is evidence that there is a softening of the market. Major agencies are reporting that inquiry levels are down on the previous 3 years, and it is often the case that tenants are remaining and renewing leases in potentially suboptimal premises simply to ensure that they have a home for the next 3 to 5 years. As alluded to earlier, there is now clear evidence that the rentals are increasing at a lower rate of growth, and it is anticipated that growth will plateau in smaller Australian markets and in New Zealand. Of course, owners, particularly the institutional owners, will want to maintain healthy face rents to maintain their balance sheet credibility. So we anticipate that incentives will slowly increase, particularly in those smaller markets and in New Zealand over the next 18 months. We will also mention a few other trends that are emerging in the market. We have touched on multi-story warehousing before, but now there is actual products being delivered to the market. At this stage, it's only 2 or 3 levels, and it is located in the inner suburbs where high rentals can be demanded in the order of $350 to $400 per square metre and can offset the higher land and construction costs. There have been strong interest from e-commerce users looking to satisfy their last mile requirements for these multi-story industrial complexes. Finally, as with the other sectors, environmental initiatives are becoming increasingly relevant and in demand by occupiers. Not only can it contribute to a reduction in carbon emissions, it can also potentially lead to cost savings. For example, rooftop solar panels are being rolled out by industrial developers in response to occupier demand as a means of reducing energy costs through selling excess energy into the grid and passing it on to the occupiers to offset increased energy costs. So where do the opportunities lie? The industrial market has been in an upward trend for the past decade, experiencing year-on-year rental growth, decreasing vacancy, and dwindling incentives. And while the market is adjusting to lower demand and some better levels of supply, there is still little leverage for tenants, both in terms of the market conditions and lease conditions. And the sustained growth of the market has skewed the norm toward the landlord. In order to shift the needle on the barometer back in favour of the tenant, careful consideration of business needs are required, expert knowledge of the market, experience and patience are all essential. On the next slide, we'll look at the potential strategies that can assist in moving the needle on the barometer to a more balanced, tenant-friendlier situation. It is clear that the industrial market remains tough for the tenant, which certainly limits the leverage available. Nevertheless, there are a number of strategies that we have used to improve an industrial tenant's position. Our negotiation strategies turn on the 5 key categories of costs, risks, flexibility, obligations, and guarantees. Whilst there should always be attention given to cost, in a market such as the current industrial market, driving costs down is not impossible, but is a difficult proposition, and it is arguably that better outcomes may be achieved by a focus on other factors such as risk and obligations. A strategy we often apply, particularly for multi-site occupiers, is a portfolio review in which we take a strategic view to identify opportunities to better align a client's property portfolio with its business needs in order to optimize its property performance. A topical example of this is a trend for a number of Sydney occupiers that are looking to relocate and consolidate their footprints to another city or further afield in order to take advantage of more favorable rents. Another strategy available is to look at mitigating risk and transferring certain obligations to the landlord via side deeds or through a variation of an existing lease. Everything is negotiable, but make no mistakes, it's hard yards and takes skill and patience. A good example of this is in the industrial sector is a commitment or obligation on the landlord to meet certain energy targets through initiatives such as solar power. Increasingly, we are negotiating provisions in a lease of this nature.